There are different types of annuities. Some of them I'm comfortable with. I have to say, in all honesty, in general, I'm not much of a fan of annuities. But with that said, there are some that for me are tolerable. A fixed annuity, for instance, is a fine alternative. A fixed annuity is like a CD. Let me go back real quick and say what is an annuity, okay? An annuity is an insurance contract, which basically is an umbrella over an investment, and that umbrella protects it from taxes. So if you're a person that has CDs or other investments where you don't use the income from those, you let it just roll over in your account, reinvest in your account, you still have to pay taxes on that money. So if you put it in, if you use a fixed annuity, you have your principal earning interest, you have your interest earning interest, and you have the money that would otherwise go to pay taxes earning interest. However, when money comes out from underneath the umbrella of an annuity, it's taxable. Okay? I'll talk more about that in just a second. Variable annuities, I have a much harder time with. And without throwing out a lot of my personal opinions on this, what I want to do is steer you to a place where you can get a lot of good information about the pros and cons of a variable, as well as the equity indexed annuities. And that's an organization. Don't write down the name of the organization, just write down the letters. I'll give them to you. FINRA.org. FINRA.org. That's the Financial Industry Regulatory Authority. You go on there and you open up the site where it says investors or individuals, and you'll see something that they call their investor alerts. And they're called investor alerts, but really they don't tell you to do something or not do something. All they're saying, if you're contemplating an annuity, and they have this all listed alphabetically, and they have like 5 different alerts on annuities. If you are thinking about this, here's what you need to know. Here are the questions you need to ask. It doesn't come down and say, don't buy an annuity. It doesn't say, yes, buy an annuity. It just gives you all the information you need to know about it. Here's my rub with, in all honesty, and I'm not just picking on annuities here. Same thing applies to any other kind of tax-deferred investment, like an IRA. Okay? These are tax-deferred investments, tax-deferred. Let me ask a show of hands here. How many people in the room think 10 years from now income taxes will be lower than they are right now? So what are you doing? In a tax-deferred product, you're deferring paying taxes to a time when taxes are going to be higher. Does that make any sense whatsoever? No, not really, not really. You have other options. If you have an IRA, or if you're thinking about opening an IRA, or maybe even a 401k where you work, explore the concept of what is called a Roth IRA, or a Roth 401k, where your growth is tax-free. Now, to get tax-free, you've got to give up something, okay? With a traditional tax-deferred IRA, the money that you contribute to that is not taxed. Okay, and so you're able to remove the year you make that contribution from your pay, from your earned income. That reduces the amount of money you have to pay that year on your taxes. But over a long period of time, as that money grows, you're going to find that you're much better off waiving that little benefit in the year you make the contribution in order to have tax-free growth to you, your beneficiaries, and everybody the rest of the way. It's really expensive. It's really expensive to have tax-deferred accounts, because it just means that over time, for instance, let's say that you have an IRA or an annuity, and you invested $100,000 and it's now worth $500,000, and then you die. It goes to your beneficiaries. The government's going to take about 1/3 to 40% of that in taxes that have not been paid. However, if you had made the same investment just in your name in a personal account, not any kind of fancy account, just an account in your name, same exact investment, it grew from $100,000 to $500,000, you die, it goes to your beneficiary, how much do they have to pay in taxes? Not a penny. Not a penny. Because they get what is called a step up in value at the time of your death. That becomes their cost basis. So that to me is the really cruelest hoax of tax deferral.